Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 3rd of September 2015 and we are going to review tomorrow's US jobs report and its potential impact on the Fed's interest rate decision. With a Fed rate increase on the horizon, the jobs data becomes that much more important. In early August, Kathleen Bosyancik, an economist at Oxford Economics USA Inc., said, "On a scale of 1 to 10, if you ask me how important the employment numbers are, I'd put it at 10. The next two figures are like 10 plus plus, meaning that the September and October figures were even more important." However, Bloomberg came out with a headline today saying, "Don't trust Friday's US jobs report." Now we quote them. If the US economy added a ton of jobs in August, the promised increase in borrowing costs will be seen as a done deal for this month. If employment falters, the soothsayers of finance will scribble that the Fed stays on hold for a while longer. Except that it turns out that the August report is the least trustworthy of the monthly jobs figures. Harm Bandholz, the chief US economist at UniCredit in New York, has done the maths on the Bureau of Labor Statistics figures. He found that August has had the lowest average monthly gain since 2011. So it shouldn't be a surprise if it turns out that the economy didn't add the forecast 217,000 jobs last month after all, Bloomberg quotes. For August's average in the past 4 years is a paltry 102,000. Interestingly, Bloomberg's World Interest Rate Probability Calculator says traders and investors now see a 32% chance of the Fed raising rates this month, up from 24% a week ago. History would suggest that relying on Friday's economic report to gauge whether the Fed should move would be a mistake, both for traders and for policymakers. However, Andrew Sergel of US News published the headline yesterday, "US job growth speeds up in August." US job growth picked up the pace last month as the labour market tacked on 190,000 new positions, according to the ADP National Employment Report issued on Wednesday. August's employment numbers clocked in slightly below analysts' expectations, but was still an improvement from a surprisingly weak July. July's previously reported 185,000 new jobs were revised down further to 177,000 this month, making the labour market's slowest pace of growth since March. The ADP numbers are released at the beginning of each month, usually a few days before the Labour Department publishes its own more encompassing employment report. Though the ADP figures offer a glimpse of what could come out of the government's official analysis, which will be published tomorrow, the two estimates draw from different pools of data and don't always line up. It's really these last 2 weeks that have been a real problem in terms of China and market volatility and all of these other things, Phil Orlando, Chief Equity Market Strategist at Federated Investors, says. He added, "If you and I had this conversation 3 months ago, I would have told you I'm locked in on September. But I'm less locked in on September today than I was 3 months ago." Robert Henley of CBS Money Watch states, conventional wisdom holds that if the Bureau of Labor Statistics reports Friday that the US added at least 200,000 jobs, the economy will still be considered in recovery mode, and the Fed will be more likely to move ahead with a rate hike, the first in nearly a decade. So, should we be hyper-focused on Friday's jobs report as the way to most accurately judge the relative health of the US economy and the future of interest rates? Definitely no, said Jared Bernstein, Senior Fellow at the Centre on Budget and Policy Priorities. I am frankly concerned that so much reliance is being put on such a noisy indicator that reflects just 1 month. Bernstein, who has served as a top economic advisor in the Obama administration, warned that taken alone, the jobless rate can be deceiving. When the unemployment rate falls, it's not necessarily good news, he said. It could mean you had more jobs created, but it could also mean more people dropped out of the labour market. For Bernstein, the more relevant data points are indicators like wage growth. He says, if a labour market is truly nearing full employment, we should see more in the way of wage growth, something we have seen in the past. It could take a blockbuster payroll report Friday to nudge the Federal Reserve into raising interest rates this month. But after recent market turmoil, some economists say the Fed won't move, even if the job gains are eye-popping. September is most probably off the table, says economist Jesse Hurwitz of Barclays Capital. The Fed hasn't raised its benchmark rate since 2006, and it has hovered near zero since the 2008 financial crisis. Economists expect the Labour Department to report that employers added a solid 218,000 jobs in August, in line with the 211,000 average monthly additions so far this year. Payroll processor ADP said on Wednesday, which we mentioned earlier, that its own sampling showed businesses adding 190,000 jobs last month. But Hurwitz says even 300,000 gains, a further drop in the near-normal 5.3% unemployment rate and accelerated wage growth won't move the Fed's needle. His reason is simple. It takes at least a couple of months for battered markets to affect the real economy, and the impact likely won't be evident in economic reports released before the Fed's 16th to 17th meeting. Stocks have fallen nearly 7% the past couple of weeks, notwithstanding Wednesday's rally. Oil prices have been volatile, and the dollar has strengthened. Developments triggered mostly by China's economic slowdown. So, is Peter Schiff right when he said on Kitco News this week? When asked whether he thought the Fed would raise interest rates, he replied, "I don't think they're really considering it, or ever have." Time will tell. Our view is that we are at an impasse. If the jobs figures are good, there will be pressure to raise rates. If not, they are unlikely to be raised. However, even if they are good, will the Fed risk a stock market collapse by raising rates in view of the losses recently experienced? Equally, if they don't raise rates, then there may be a lack of confidence in the Fed, and the markets fall anyway. This is the dilemma, an answer to which will be known in a little over 2 weeks' time. We hope you have found this video useful. If so, please give it a thumb up, comment, and if you haven't already done so, please subscribe. Also, it would be helpful if you could share this on Twitter and follow us at IlluminatiSilv1. Disclaimer. Silver Illuminati owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.